Welcome to the Explainer. Today, we're completely demystifying the mechanics of cryptocurrency. We are taking you all the way from basic wallet security right to the bleeding edge frontiers of decentralized finance. Now, the crypto world can definitely feel like a maze of jargon and complicated interfaces, but we're going to break it all down using clear, intuitive building blocks. So, whether you're just trying to figure out how to safely store your assets or you're ready to put those assets to work, this Explainer is designed to give you a rock-solid foundation. Let's dive in. Here's our game plan for today. Crypto wallets explained, hot and cold wallets, decentralized finance basics, lending, staking, and liquidity, the world of stablecoins, and finally, real-world assets and airdrops. Section 1. Crypto wallets explained, keys to the vaults. All right, let's start with the absolute foundation. You'll often hear people talk about a public key or a wallet address. Now, if a public key is basically like your bank account number, something you can safely share for people to send you funds, your private key is the ultimate proof of ownership. It's the cryptographic secret that actually authorizes transactions on the blockchain. And I literally cannot stress this next point enough. There is no customer service desk in crypto. Protecting your private key and your seed phrase, which is usually a 12 to 24 word list that can recreate your private keys if you ever lose your device, is your absolute top priority. I mean, people have literally dug through city landfills for weeks looking for lost hard drives because they forgot this rule. If someone gets these keys, they control your funds, period. So store them analogically, keep them offline, and never, ever type them into a random website. Right, before we move on, let's clear up a massive point of confusion: the distinct difference between a native coin and a smart contract token. A coin, like Bitcoin, Ethereum, or Solana, is the native cryptocurrency of its very own blockchain. It's primarily used as a medium of exchange and to pay network gas fees. A token, on the other hand, is built on top of those existing blockchains using code. Tokens like USDC or Uniswap are used for specific utilities, governance, or representing ownership. Section 2. Hot and cold wallets, securing your assets. Okay, so there's a core philosophical shift in crypto, right? Moving from trusting a centralized third party to taking full self-custody of your wealth. You've probably heard the classic crypto adage, not your keys, not your coins. When you leave your assets on a custodial exchange like Kraken or Binance, they hold the private keys. You're really just trusting them with an IOU. But with a self-custody wallet, you are the bank. You hold the keys. The trade-off, of course, is that total control means total responsibility. When you're picking a cold wallet, which keeps your keys totally offline and shielded from internet hackers, your choice really depends on your daily setup. Both the Trezor Safe 5 and Safe 7 are open source, they've got touchscreens, and they support all the major assets like Bitcoin, Ethereum, and Solana. Now, the Safe 5 is a fantastic value for a wired USB-C desktop setup. But if you rely heavily on an iPhone and need Bluetooth and wireless charging to transact on the go, the Safe 7 is definitely the ideal upgrade. Now, for your hot wallets, the internet-connected browser extensions you actually use to interact with apps, keeping it simple is the name of the game. When you connect your cold wallet to these hot wallets, the private keys remain safely offline on your Trezor. Starting with a multi-chain interface like Newfie is ideal because it handles Bitcoin, Ethereum, and Solana all in one seamless place. You really only need to add Rabby as a specialized fallback for Ethereum. Honestly, power users often prefer Rabby over MetaMask because it has far superior built-in security checks that simulate a transaction before you ever sign it. And if a native Solana app is demanding a specific connection, Backpack is your best fallback there. Section 3. Decentralized finance basics, the bankless economy. Think of a smart contract basically as a digital vending machine. It automatically facilitates lending, borrowing, and trading without any human intervention at all. You put the token in, the code executes, and the exact programmed result comes out. This completely removes the need for traditional middlemen like banks or brokers, effectively democratizing access to financial services on public blockchains for literally anyone with an internet connection. And one of the biggest leaps in DeFi is the decentralized exchange, or DEX. Centralized exchanges operate a lot like the traditional stock market, relying on an intermediary to match buyers and sellers through an order book. But a DEX, like Uniswap or Orca, completely replaces those traditional centralized order books by utilizing automated liquidity pools. There's no broker. It's just peer-to-peer trading governed strictly by smart contracts directly on the blockchain. Section 4. Lending, staking, and liquidity, earning yield. So how do you actually make money in this ecosystem? Well, lending and staking are the two safest and most sustainable ways to get started. Lending provides yield from over-collateralized borrowers. You deposit stablecoins, borrowers pay interest, and you get a cut. Pretty simple. On the other hand, staking, especially liquid staking with assets like Ethereum or Solana, pays you directly for helping secure the network itself. Plus, with liquid staking, you get a receipt token back that you can then use in other DeFi protocols, effectively compounding your opportunities. Now, if you want to become the exchange yourself and earn a share of the fees every time someone trades, you can dive into yield farming. You provide a pair of tokens to a smart contract pool, receive liquidity provider tokens, stake them, and earn trading fees plus protocol rewards. But be warned, this is the Wild West of DeFi, and you face something called impermanent loss. If the two assets fluctuate wildly in price against each other, the smart contract rebalances them automatically. You could easily end up with less of the winning token than if you had just held it safely in your wallet. It's high risk, high reward for sure. Section 5. The world of stablecoins, anchoring value. Stablecoins act as a safe haven, connecting traditional money to the blockchain to avoid extreme volatility. But they are absolutely not risk-free. You're basically exchanging market risk for systemic risks, like smart contract bugs or issuer insolvency. A depeg happens when the coin moves away from its $1 target. And here is a massive pro tip. A rising interest rate, or APR, during a depeg is almost always a massive warning sign of a failing token trying to trap liquidity, not an opportunity to make a quick buck. Looking at the major players, there's a pretty diverse ecosystem of stablecoins. Fiat-backed options like Tether's USDT and Circle's USDC rely on off-chain cash reserves and government debt. They're heavily centralized but highly liquid. Then you have crypto-collateralized coins like DAI, which are more decentralized but rely on over-collateralized smart contracts. And finally, you have synthetic options like USDe. Instead of holding dollars in a bank account, USDe maintains its peg by using delta-neutral derivative hedging, essentially shorting Ethereum or Bitcoin while holding the spot asset to capture funding rates and stay perfectly anchored to a dollar. Knowing exactly what backs your stablecoin is absolutely crucial to understanding its risk profile. Section 6. Real-world assets and airdrops, the bonus round. Finally, let's explore how crypto is absorbing the real world. This is one of the fastest-growing sectors in DeFi right now. Real-world assets, or RWAs, bring traditional finance directly onto the blockchain. Protocols like Ondo and Centrifuge are allowing users to access institutional-grade yields from things like US Treasuries or private credit markets, right from a self-custody wallet. No banking hours, no complex accreditation hurdles. But remember, this does introduce counterparty risk. You are trusting the issuer to actually hold those physical assets safely out there in the real world. Meanwhile, as these DeFi protocols grow, they use airdrops to acquire users. Instead of spending millions on Google ads or Super Bowl commercials, protocols launch points programs. You literally farm these points by actively lending, swapping, or providing liquidity on their platform. Eventually, during a token generation event, those points convert into an airdrop of free tokens. It can be highly lucrative, but the absolute smartest approach is to treat airdrops as a bonus for activities you'd be doing anyway, rather than guaranteed income. We have covered a massive amount of ground today, from protecting your private keys and choosing the right cold wallet, to navigating liquidity pools, understanding synthetic stablecoin risks, and farming airdrops. But it leaves us with this final provocative thought. The merge of traditional finance and blockchain technology is no longer just some distant idea. It's actively happening right now. The tools for true financial self-sovereignty are right in front of you. So the question is, how will you use them to take custody of your own financial future? Thank you so much for joining us in this explainer, and keep learning.